Hi, everybody. Welcome back to Ox Talks. It is Tuesday, February 13th, 2024. Hope you guys are having a productive work week so far. Apologize for missing yesterday's video post. I intended to get back from the location I was visiting on Sunday evening, but coming out of the LA Basin yesterday later in the day, I hit a bunch of unexpected traffic, just could not get back in time to get a video filmed and uploaded yesterday. But with that being said, let's jump into what I've been seeing the last couple of days. Today was obviously a big day with the CPI release, so we'll address that. I actually had pulled an article yesterday that I intended to share with you last night. It is actually even more relevant, I think, now today, given the data that data released this morning on the CPI. And of course, I have another article to share with you relative to more layoffs. So let's jump into it. I appreciate all of you subscribing to the channel. We talked about this a few days ago. I'm getting word that people are being unsubscribed on a regular basis from the channel. So if you would please keep checking that for me. And if you need to, please make sure you're subscribed or resubscribed. I think it would also help if you hit the bell notification and make sure that that's always highlighted so you get notification when the new videos are released, and you may be able to track if you've been unsubscribed for whatever reason. But again, thanks for being here. I know you have a lot of options of a lot of other bloggers putting economic stuff out on YouTube. Means a lot to me that you take the time. Let's continue to spread the word, try to wake those up that want to be awakened. I will say this, the company I was in on Sunday was not, let's just say, economically and politically aligned necessarily with my belief system. I've discussed this before. I don't feel a need to try to convince others what my beliefs are necessarily. I will share my position on things if I'm asked or if I'm involved in a conversation. But this was a situation where the political leanings were obviously apparent, and so I just kind of observed. And sometimes, it's great to just step back, take everything in, listen to what other people are saying and what their belief systems are. And sometimes it gives you a very, very critical insight into the pathway to what is happening now and the mindset. I will say that it's a lot of what I saw and heard is not encouraging, but it is reality. So took a lot in the last couple of days, and I was happy to get back home yesterday evening and back into familiar surroundings. Anyway, let's talk about what's going on with this economy. I'd be remiss if I didn't address just briefly the CPI release from today. From Zero Hedge, it says expectations were for a big drop in year-over-year consumer price index, i.e. inflation. And the expectation was from a positive 3.4% to a positive 2.9%. And instead, it's surprised, always is a surprise, to the upside, with a 3.1% year-over-year print for headline CPI, spoiling the people's hopium that hoped it was going to be below 3%. It says consumer prices rose 0.3% month over month, more than the 0.2% expected. But the headline CPI did decline from plus 3.4 to plus 3.1 year over year. But the numbers really are ugly. The things that are going up are not, it won't be a surprise to you. Things that continue to go up are the items that we all need or rely on a daily basis to survive. So let me run through the list real quickly. Rent inflation, 6.9% up to the upside year over year in January versus 6.47% in December. So rents are going up. Shelter inflation was plus 6.04% year over year in January versus 6.15% in December. No surprise here. Motor vehicle insurance index increased 1.4% in January, and the recreation index increased 0.5% in January. Among other indexes, it says that rose in January were communication, personal care, airline fares, and education. There's the medical care index rose 0.5% in January. The index for hospital services increased 1.6% over the month, and the index for physician services increased 0.6%. So all of the things that we are paying for on a monthly basis, we've discussed insurance costs on this channel, we've discussed the skyrocketing food costs, meat, staple items, medical care costs, all those things continue to rise. So the hopium was a bit, the fairy tale ending and the soft landing today may have been shattered. I titled the video, "Could this be the start of a disorderly, unwind?" The stock markets sold off pretty good today. At one point, the Dow was down over 700 points, but I did see it close down about 500 or so down today. Similarly with the S&P and the Nasdaq, they all fell about 1.5%. So is this the start of a broader sell-off, given that the markets are going to have to start waking up to the fact that the Fed is not going to start cutting rates anytime soon? The markets had already pretty much taken off the table any kind of a March rate cut, given the Fed's comments over the last couple of weeks. And now it seems, and of course they shifted expectations to the May meeting. Again, it seems to me now that May probably is off the table. And are we even going to get those 2 or 3 rate cuts the Fed was, or the market was pricing in, expecting over the remaining course of 2024? It wouldn't surprise me if we do not see that. Again, that has broader implications for the economy if these markets do start to sell off. So let's address the related item relative to the continued, let's say, stubborn inflation, and that's dealing with commercial real estate. We've discussed this a lot as well on this channel, but it bears worth bringing to your attention if I need to every day as this stuff unfolds. It says, this was from Zero Hedge. The article I saw was going to share with you yesterday. It's even more appropriate now for today. It says the latest inflation figures in the United States look relatively positive, with a slight decline in annualized inflation rates. However, only three items in the CPI components declined in December. Again, this article came out yesterday before the release of the official CPI numbers today. It says persistent inflationary pressures that threaten to undermine the rate cut narrative that financial markets have adopted are present below the surface. It says investors expect the Federal Reserve to pump the monetary laughing gas machine, anticipating further rate cuts and monetary easing to support multiple expansions. However, in this wave of fervent optimism, there are dark clouds looming on the horizon, it says. Another wave of regional bank troubles added to the burgeoning crisis in the commercial real estate market. So you still had, even as of last night, markets expecting a more benign inflation number. They did not get that. So will this again kick off a more broader-based lack of confidence in the Fed's direction? We'll have to see, starting with tomorrow when everything opens up. The article continues, the regional bank crisis was disguised with liquidity, we know that, but reality showed that unrealized losses in the bank's balance sheets rose to all-time highs in the third quarter of 2023. Regional banks, it says, remain in deep trouble. And now, look at, the banks are going to start understanding this data as well and are going to realize they're going to have to accept the reality, if they haven't already done so, that the markets have got it probably priced in wrong, and that without a whole bunch of rate cuts coming, these banks are likely going to be taking more non-performing, more defaulting loans onto their balance sheets, which will further weaken these banks. This is according to Moody's. Major U.S. banks are sitting on $650 billion in unrealized losses. Those are the major banks. It says things are even scarier in the land of real estate. Recent reports paint a grim picture of the commercial real estate landscape, with delinquency rates soaring to alarming levels and non-performing loans rising. So is the commercial real estate market, once an example of economic strength, stability, and prosperity, now stands on the edge of crisis. Delinquency rates on commercial real estate have reached a 10-year high, with almost $80 billion worth of property, it says, in distress. So what does this mean for the Federal Reserve? The Fed finds itself caught between a rock and a hard place, having to choose between inflation on the one hand and financial stability. On the one hand, persistent inflationary pressures require a monetary contraction and maintaining elevated rates. On the other hand, the risk of a collapsing commercial real estate market threatens to unleash a wave of financial contagion with far-reaching implications for the broader economy. And I thought this was important. It says, remember 2007. Market participants at that time also at that point said the subprime was not a threat. Remember, the subprime is contained, those words that were spewed out all over the place in 2007. It says because it was a relatively small proportion to all assets in the financial system. This is the same argument that we are reading about today. However, the risk of contagion and the domino effect of corporate bankruptcies, number one, and impact on all real estate, not just commercial, is not a small thing to consider, it says. The challenge is that by cutting rates, cutting rates may be too little for the accumulated problems of the commercial real estate sector. And I always was wondering, I mean, if you cut rates, let's say 3 times, quarter basis point, maybe you have a 75 basis point or even a full basis point cut, over the next year. What's that really going to do for all these defaulting loans and non-performing loans that are sitting in loans, that are coming due for refinance, in the 3s, maybe even the high 2s or 3s? We're still well over double that. It says it's not just a problem of rates, but the evidence of bloated valuations and rate cuts also exacerbating inflationary pressures and fueling other asset bubbles. Well, that's why you're seeing as well inflationary pressures on rents and shelter costs. So continue to report on how this is tied into the commercial real estate. I have a good friend of mine that owns a commercial real estate brokerage and friend and client. And from what I understand, the commercial real estate business is down precipitously. And I don't see it picking up anytime soon. We'll see how it plays out. The last article I want to share with you today was out of CNBC this morning, continuing the layoff theme. Paramount Global, it says, is laying off hundreds of employees just one day after the company announced CBS had record Super Bowl viewership. According to Chief Executive Officer Bob Bakish said Tuesday with an internal memo to the company's employees. It says Paramount will lay off about 800 people, or an estimated 3% of its workforce, according to a person familiar with the matter. Paramount Global ended 2022 with about 24,500 full-time and part-time employees, it says. Quote, these adjustments will help enable us to build on our momentum and execute our strategic vision for the year ahead. What do you think that vision is? Here it is. Be much more excited. Paramount shares fell 4%. The global vision is to be more efficient, is to be cutting costs and worrying more about the bottom line, worrying about the valuation and their stock values, worrying about what their investors think as opposed to having a warm and fuzzy employer-employee environment. So another company, this is outside the tech sector. These layoffs are not limited to tech, and let's see if it becomes broader based in the entertainment industry. The article concludes by saying Paramount Global owns a variety of assets, including CBS, Paramount Pictures, Pluto TV, Paramount Plus, and cable networks, including Nickelodeon, BET, and Comedy Central. So I sure hope that you're not one of the 800 people there getting notice that you no longer have a job. We discuss on this channel regularly that if you can start your own business and try to fortify yourself with your own income stream, you really need to, from my perspective, not financial advice or legal advice, but please consider doing that. These layoffs are going to keep getting worse, folks, I believe, this year and into next, especially if we have a continued sell-off in the stock market. Yes, gold and silver were under a lot of pressure today. The dollar was almost 105 on the U.S. index. The 10-year spiked, I think, almost 15 basis points. It's at over 3.3% now or something like that. So these metrics are all going in a very ugly place right now, in a very ugly direction. That being said, I'll finish up with today my comment about fitness. I did get a workout in late yesterday because, for me, it's a mindset thing. It's a stress issue. I just need to get that workout in every day. So I hope that all of you are doing the same thing. Please get those steps in. Keep walking, half an hour a day if you can, and do some strength training, sit-ups, push-ups. The diet's crucial. I really was careful, even though I went to a gathering on Sunday. I was very careful. Could I have become, lazy with that? Sure, but I did not. You can usually make good choices with food, even if you're not within, your confined environment where you control your diet and what you eat, what's in your refrigerator. So just make smart choices with the diet. That's as important, if not more important, than the exercise. Appreciate all your comments. I do enjoy reading them and the interaction you guys are having with each other. I'm a little long here today, but I enjoy coming out and talking with you, and I will see you all tomorrow. Have a great evening. Bye.